Guys, welcome back to a brand new video. I'm RexFinance, and today I'm going to be starting a brand new series on this YouTube channel. What this series is the state of the stock market, but I need you guys as input. Should this be a monthly series or should it be a biannual series? What biannual means is I would do this series once in June, halfway through the year, and then once again at the end of the year in December. So let me know down in the comment section down below what you guys would prefer. July has the potential to be a very exciting month in the stock market for several reasons. First, we have all of the big banks reporting their earnings in the first couple weeks of July. And then after that, we move to big tech. So names like Microsoft, Apple, Tesla, and companies like that. In my personal opinion, the earnings reports on these companies are going to be somewhat meaningless. What is going to matter is the forward outlooks that these companies give. Because the vast majority of analysts on Wall Street believe that second quarter earnings are going to be the peak of this recovery, meaning that going forward, earnings growth is not going to be as impressive. However, what this means is that the companies that actually come out and forecast very positive earnings growth going forward in the second half of this year likely are going to see their share prices skyrocket. Inflation, cryptocurrencies, meme stocks, and employment could dominate the month of July and what stocks do in particular. But before I get into the meat of this video, I want to say thank you to Chris and Sean for recently subscribing to this YouTube channel. And I also want to say thank you to Carlo and Rob for joining my paid monthly membership. If you guys are interested in joining that membership and receiving my buy and sell alerts, extra access to me, etc., there will be a link down below in a pinned comment. But anyways, now let's get into the good stuff. It would be a sin if I did not start off by talking about AMC and the meme stock culture that has come upon us. Meme stocks made a reappearance actually at the end of May when AMC went from around $12 a share to over $60 at one point in time. However, throughout the month of June, it has been very, very stagnant. Basically a flat line throughout this entire month. However, I think looking into July, this type of price action could be a big deal for AMC and all the other sympathy plays. This type of sideways price action can be detrimental to short sellers. The reason this is because short sellers pay a fee to borrow the shares that they sell on the open market to effectively short the stock. So as the share price is stagnant and flat, these short sellers are still having to pay fees out of their own pocket. Eventually what's going to happen if this type of trading behavior continues is that these hedge funds, these short sellers are going to run out of money to effectively pay their fees to continue to short this stock. Another reason this type of price action is detrimental to short sellers and hedge funds in particular is because the investors that entrust hedge funds with their money to get a return are expecting a return. They're expecting to beat the markets. And if their money is slowly eaten away because of these fees that these short sellers are having to pay to short this stock, they're not getting a return. The return is flat and or negative. So if this sideways behavior continues for hedge funds, they could be in a lot of trouble as their investors start to pressure them to do something, to make a move here. Either double down on your short and try and send this lower, or take your foot off the pedal and start covering your short. Now, although June was a flat month for AMC, there's another reason June was a big month, and that's because of the sympathy plays that started to pop up thanks to AMC. What AMC caused to happen is retail investors looking for heavily shorted stocks on purpose to hopefully burn more hedge funds that are shorting these companies. So just to give a couple examples of this, we had Clover, which was trading around $7 a share, skyrocket to over $20 a share in the beginning of June. Further, just recently we've seen Workhorse actually gain attention because Workhorse is the most highly shorted stock in the entire stock market at over 45% short interest. The beginning of this move in Workhorse really didn't come till the end of June. And honestly, guys, this meme stock culture is not going to go anywhere despite what anybody might tell you. In my personal opinion, until we have an economic depression where people literally do not have money to throw into the stock market, meme stocks are here to stay, and that's just a simple fact. In the month of June in particular, the cult-like following of these meme stocks grew exponentially. And we've seen it with AMC and all these sympathy plays. When retail investors join the meme stock movement, they're here to stay. These stocks have traded sideways, meaning that retail investors are still buying into this stock as the shorts doubled down on their positions. So again, I think hedge funds are in a lot of trouble here if retail investors keep up what they're doing. They've shown that the cult-like following is going nowhere. Then throughout June, what we've seen is the recovery names that were so popular as our growth stocks crumbled, they've all of a sudden started to crumble themselves, and money has started flowing back into these growth stocks. Just to show an example of this, at the beginning of June, Carnival Cruise Lines was trading at over $30 a share. Today, they're trading at $26 a share. That's effectively a 16.5% decline in share price over the past month. We've seen the same thing with Win stock. where they were trading at over $135 a share at the beginning of June, but now they're just trading over $120 per share, effectively a 10% decline in the share price throughout the month of June. So looking into July, what I think is happening here is the markets are actually starting to believe the Fed when they say that inflation is going to be temporary. One of the main catalysts for these growth stocks crumbling was the fear that inflation rates would run rampant. However, as the markets, as I've stated, have started to believe the Fed and what they're saying that inflation may actually be temporary, we've seen money start flowing back into growth. So going into July, I personally think this type of behavior is going to continue. Everything works in cycles in the stock market, where different industries are doing better than others, where different segments within the index funds are doing better than others. For example, since the beginning of 2021, energy stocks have outperformed any other class of stock. However, tech stocks have really struggled in 2021, up just 10%, while energy is up over 40% since the beginning of the year. So the cycle we're seeing now is the reverse of what happened when our growth stocks crashed. What's happening now is money is coming out of these recovery plays and they're flowing back into growth stocks. But even though I think growth stocks are going to vastly outperform any other class of stock out there throughout the rest of 2021, there's still a chance that this battle between value investing and growth investing continues in July. What actually happens will almost entirely depend on what the Fed's stance is going forward on inflation. If they continue to preach that inflation is going to be temporary, while growth stocks and tech are going to continue to succeed. However, if the opposite happens and the Fed changes its stance on inflation and says this is going to be long run inflation, well then all of a sudden the money is going to flow back into the value stocks. I also want to note, and you guys can watch this video by clicking the eye in the top right hand corner, that the deals right now are not in large cap stocks. The deals right now are in small caps and maybe some in mid caps. I cover this in depth in a video I did just recently. Again, hit the eye in the top right hand corner, or there will be a link down in the description below. What this video was titled is Warning, Why I Quit Dividend Investing and I'm Going All In on Growth Stocks. This has to do with my belief that growth stocks are going to vastly outperform any other class of asset throughout the remainder of 2021. Valuations for large cap companies are the highest they've been since the tech bubble. However, with small caps, they're largely in line with what we've seen historically. So right now, most of the deals you can find in the stock market are in small cap stocks. Another catalyst is going to be how cryptocurrencies perform. In June, cryptocurrencies traded a lot like the meme stocks did, pretty much sideways and slightly negative. But just over the past few days of June, we've seen some strength re-enter the cryptocurrency market, with Ethereum and Bitcoin showing really good signs of strength moving forward. In today's day and age, whether you want to admit it or not, cryptocurrencies do have some pull on what the stock market does, especially as the companies within the stock market start buying and adding cryptocurrencies to their balance sheets. So as strength in cryptocurrencies come back, companies like Tesla that own Bitcoin on their balance sheet are going to benefit from the price of Bitcoin increasing. The reason for this is because if the price of Bitcoin goes up, well, the value of one Bitcoin also goes up. So depending on how many Bitcoins are on a balance sheet, that company owns more assets if the price of Bitcoin goes up. If the price of Bitcoin goes down, the opposite happens, which is probably part of the reason you've seen some weakness in Tesla stock. So I already briefly mentioned that the tech and growth stock recovery has already started. Now, the time to be buying was back at the lows in May. The best time to be buying isn't now, it was back then. However, if you guys missed the boat and you did not end up buying shares of tech and growth at their lows, you can really still take advantage of this. As with any cycle in the stock market, as tech and growth recovers, there's going to be hiccups and dips along the way. That is the opportunity for you to add shares of your favorite tech and growth companies. So although I think July is going to be great for tech and growth stocks, I also believe that there's going to be hiccups and dips along the way, in which I would be adding if I missed buying at the lows. June was relatively a boring month for stock market retail investors, but July has the potential to be very, very exciting, and there's a chance we've just started our next euphoria rally, where stocks rally up 8 to 10% on any given day. For example, Enphase Energy, a growth and a tech stock, is up 35% over the past month. If we look at Tesla, it's very, very similar. Over the past month, it's up 10%. So when we compare this to Carnival Cruise Lines and Wynn Resorts, it's basically the inverse that is happening, where recovery, the Wynn Resorts, the Carnival Cruise Lines are going down in share price, while Enphase and Tesla are going up in share price as money cycles back into tech and growth. I stated at the beginning of this video that forward guidance is going to be very, very important for these companies as they report their earnings. Their performance over the last quarter is not going to mean much. What's going to mean a lot is if companies come out with very positive earnings projections throughout the second half of 2021. 2021, because again, the vast majority of Wall Street analysts believe that second quarter earnings are going to be the peak of this recovery. So the companies that prove these analysts wrong and come out with very, very strong forward guidance are likely going to see their stock prices skyrocket. And if we dig a little bit deeper, the companies that are going to come out with positive forward guidance are not these large cap stocks. They're not the recovery stocks. They're the growth and they're the tech stocks. Also looking forward into July, we're going to get some jobs numbers from the month of June. These are going to be somewhat important because April and May jobs growth numbers came in slightly under expectations. So when we get those numbers, although I don't think it's going to be make or break for the stock market, seeing jobs growth numbers exceed expectations or at least meet expectations would be a big catalyst for the stock market. But with that, guys, I hope you enjoyed the first episode in this series. The state of the stock market is what I'm going to call it. Again, let me know down in the comment section below whether you think I should do this twice a year or once a month. If you guys enjoyed this video, leave a like down below. And if you guys are new here or returning and not yet subscribed, be sure you hit that subscribe button. With that, I'll be back with a brand new video later this week. Peace out.